of around 60 or so stocks targeting the income and growth potential of Asia's most compelling and sustainable companies. We focus on finding high-quality, dividend-paying companies that offer both capital appreciation over the long run alongside a growing dividend stream. Asia is often considered a growth market thanks to the favorable demographic data supporting local consumption growth. However, dividend returns have contributed to over 50% of total returns in Asia over the past 2 decades and has delivered double-digit compound growth over the same period. Dividends are also well diversified across countries and sectors, and we're fortunate to find yield from various growth trends, including electric vehicles, online shopping, 5G infrastructure rollout, and this is all alongside the more traditional yield sectors such as financials and utilities. The fund's largest country positions are Australia, Singapore, and Taiwan, which unsurprisingly are the highest yielding markets in Asia. We've got lower weights in markets such as China, India, and Korea, which are large growth markets that are not known for their dividends. However, we've still been able to find good quality companies in these markets, offering both capital appreciation and shareholder returns. For example, whilst we own much less in China compared to the benchmark, largely because the big index weights are internet companies that don't pay dividends, instead we've been able to find good quality businesses that generate steady cash flows, where the management team are able and willing to share rewards with minority investors. We've added to our property holdings in China, such as China Vanke and China Resources Land, both well-run businesses with good balance sheets and conservative, diversified property portfolios, which we hope will be beneficiaries of a Chinese reopening story. We've also been adding to financials across the region as regulatory dividend handcuffs were loosened with reopening economies. This was funded by taking profits on some of our technology holdings, which had enjoyed a good run. Technology, however, remains one of the largest sector positions within the fund still, and our holdings are diversified across different applications, from semiconductor chips to computer cooling systems to complex components for high-tech consumer electronics. Our investment process is based on bottom-up research, drawing on the experience of a team of over 40 fund managers based here on the ground in Asia. We look for good quality and good yield at the right price, regardless of country or sector. This includes discussions and active engagement with our fund's holdings on environmental, social, and governance issues, or ESG issues, and the fund's ESG rating has recently been upgraded to AA by MSCI. Internally, we look at ESG from a bottom-up perspective. We're looking for companies that not only have high ESG scores, but also those that are on an upwards re-rating journey where we believe there's potential for their ESG score to be upgraded through engagement and with better disclosure. An example of this would be Power Grid of India, which forms the backbone of India's electricity infrastructure and transmission network. And it's responsible for about half of the domestic electricity usage in India. The core transmission assets earn a regulated return, which generates a steady cash flow that supports regular dividends. In addition, Power Grid is focusing on promoting better access to renewable energy sources in a country where energy output is still very much reliant on fossil fuels. It set up a high-capacity green energy corridor and is improving reliability and energy security with ambitious intermittency targets. More than 20% of capital expenditure for the company is going into renewables infrastructure, and we believe Power Grid will be one of the important players in the growth of renewable energy delivery to the grid over the long run. Asian markets fell in the second quarter as inflationary pressures continued to raise expectations for rate hikes across the region. China, which has had a very tough 12 months, was the only market to show positive returns this quarter, with the domestic market rising on the back of loosening pandemic control policies. The fund's net asset value has underperformed the benchmark over this period, given our lower weight to China, but we remain comfortably ahead over a 1-year period. Dividend collection from our holdings continues to improve from COVID lows, and the fund paid a quarterly distribution of 2.3 pence per share in April. The net yield on the portfolio remains an attractive 4.5%. Looking ahead, we expect that after a challenging start to the year, sentiment will remain cautious given the uncertainties around inflation and recession risks. This is especially true for cyclical companies as well as growth companies that are looking expensive on rich valuations. One of the ways we try to combat macro risks is by knowing our companies. For example, companies with good business franchises and strong pricing power can better pass on the effect of cost inflation and protect their margins, whilst companies with strong balance sheets are less exposed to refinancing risks in a rising rate environment. These types of quality indicators help us to pick the businesses we believe will fare better than their lower quality peers in times of stress. Dividends are an increasingly important component of total returns in Asian markets, and as earnings growth forecasts for the coming year are higher in Asia versus the developed regions in the West, we expect this to translate into better dividend opportunities. The fund has a 13-year track record of paying growing dividends to shareholders, with 40% dividend cover held in revenue reserves, and we're targeting a full-year dividend of at least 9.75 pence for 2022.